Hey everyone, welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. This is the live stream about personal finance, investing. We cover the stock market, we cover it all. My goal is to make you better with your money so you could be the boss of your money. And I want to put the personal back into personal finance. We get deep into the spreadsheets, we get deep into the standard deviations, the alpha, the beta. I just want you to have a better life because you're better with your personal finance and you're investing in all the great things that go around, that go with that. So without further ado, let's roll a quick intro. This is going to be a good, quick show. We just need to catch up on things. Where are we? What's going on? It's been a wild couple of weeks. And today I feel like we finally had just like a day of calm. No disasters, no blow-ups, no Bitcoin getting cut in half today. It was overall just a generally good day in the market, pleasant day overall. Let's roll the intro and we'll get into it. And we're back. Thank you so much for joining me. My name is Mitch Goldberg. If you're just joining us now, this is my live stream about Be the Boss of Your Money. We're going to get caught up on markets, the world, the financial world. So much has been going on the last couple of weeks that, I try to cram everything into this show. And I just feel like after a while, it becomes like a jumbled mess. So if you're joining me now, hit me up with any questions you may have in the comments. If you are watching this in the replay, I'd like to welcome you as well. And just like if you're watching in the live, if you have any questions, comments, please hit me up. I'll find those, I'll see those, and I would love a shot to answer those. That's the best part of doing this. It's one of those days. It was so busy. It went by so fast. I didn't even have a chance to make my usual thumbnail and schedule on social media so you see it and remind you. But that's okay. I'm here every day at 4:30, Monday through Thursday, Eastern Standard Time, 4:30. And, I was talking to somebody about that. What if you change times or do it a different time of day? People try to find themselves when they do a live stream. And my feeling is I built up a lot of equity for the 4:30 time. Like people know at 4:30, Mitch is on live about the market, an update, something about personal finance, or what have you. And, I really appreciate that's kind of known for my time, and people know to look for the live stream in the replay. And I appreciate it. I feel like, people watch out for it. They watch it at their preferred time if they can't watch it in the live. And if they do watch it during the live, they put it, the volume on in the background while they're working. And look, what could I say? Love you all. I greatly appreciate you taking the time. Your time is valuable. So the fact that you chose to share some of it with me is like really meaningful to me. So let's just do a quick update in the markets and we'll catch up on everything. Just, between the crypto and the tech stocks and the market taking a beating, a lot of the work from home, stay at home stocks were down 50% plus. Crypto took it in the chin. Dogecoin. People are like, I think a lot of people are for the first time losing money or confused about the direction of the market, or are realizing that, making money in the market is not really such an easy thing. And what I mean by this, okay, is that for people who really got involved in the market during the pandemic, let me go back to that. I like that view there, and I'll pop this in. There we go. So people who really got into the market during the pandemic and they had their stimulus money and they had nothing to do, they were home, they were trading or whatever, it was a pretty straight up market. I mean, airlines were the first things to take off, no pun intended, but they really, from, single digits to double digit stocks. And then all the work from home, stay at home stocks, the Zooms, the DoorDashes, you know, there's a ton of names in that space, and they started to take off, and it was pretty easy. And then crypto was doing very well, and I think a lot of people started to think not only was it easy, but I think there was a lot of complacency. And when I say complacent, I have another screen right here, so when I look at that, I just I can see how I'm looking, make sure I'm steady in the middle of the camera, which I am. I think a lot of people started to think making money in the market was easy, and it's a lot of complacency crept in, and people started to leverage, go in margin, and they had all the same stocks. So they had all the same work from home. I mean, if you have one work from home, stay at home stock, they're pretty much all going to trade the same. So if you bought one or if you bought 20, buying 20 was like buying the same thing 20 times. This speaks to diversification, right? Diversification in the financial investing world, just so you know, is not just about having different stocks. It goes deeper than that. What it's about is having different stocks that don't move together. It's about having stocks that zig while having other stocks that zag. It's about having some stocks that are cyclical or economically sensitive, so they do well when the economy does well. And then there are stocks that are defensive, and they shine when the economy is not so hot or when the economy is cold or in a recession. And you have different kinds of stocks that do well over different periods of time, with the expectation that over time they should all do pretty well. Now, that in reality doesn't always happen, which is why we diversify. Now, diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Okay. It's a strategy that manages risk, not a strategy to boost returns. So that's what you should know about diversification. And I think for a lot of newbies into the market, that's probably the best lesson that you could learn now. There are people that had so many stocks like Clover and other, just so many names are running through my head. And, these stocks were such great stocks for so long, such powerful. And now these stocks have tanked. And if you're a Johnny come lately to the trade, you're really losing a lot of money. Some people are at least only up a little or down a little. So these are the things that we go over on Be the Boss of Your Money. And just a little lesson for everyone. If all of your investments are up at the same time, you're not properly diversified. I know that's like hard to believe. Like, well, why wouldn't we want that? Think about it. Diversification means holding some investments that go up or holding on to some investments that go down. Now, I'm not saying you want to own an investment just because it goes down and you want to buy some junky security, although junky securities have had their day in the sun over the last few months, like GameStop or AMC and others that we could talk about. But the bottom line is you want quality. But if you take a look at a company like Dow Chemical and a company like Pfizer, they would trade differently at different times during the economic cycle. Procter and Gamble, for example, would pretty well shine in a tough economic environment, as opposed to a Dow Chemical would do very well in a very strong economic environment. And that's what you have to start picking and choosing stocks for. So don't get me wrong. I'm not saying you should buy some junky stock deliberately to lose money. Okay, don't be a wise guy. All I'm saying is what you need to do is you need to own stocks that do well at different times. This helps moderate the performance in your portfolio. This is like the international sign language for moderate the performance of your portfolio. You want a portfolio that goes up like that? My hand is so high, it's not even in the screen. Or a portfolio that plunges. My hand is so low, it's not even in the screen. You have to get better at diversification, and owning 10 or 20 stocks does not mean you're diversified if all of the stocks are correlated, meaning moving up and down together. Lesson of the day. Let's see who's out there. I know a couple of you are watching, and I appreciate that. Josh is out there. Judy's out there with the heart. That's love. And I want to thank you, sweetie. My wife gives me leeway to do my live stream every Monday through Thursday because she knows I love it. I take it very seriously because if you're going to spend your time watching, then as I'm sipping my Dunkin' iced coffee, right? If you're going to take your time to watch, I want to make sure I give you the goods. Okay, so let's take a look at a couple of things. We'll do a quick share screen. Okay, pop myself up in the corner here. Here I am. Okay, nice day. The Dow was up 186 points. NASDAQ had a big day, up almost 200 points, up 1.4%. S&P up almost 1%. Gold was up a little bit. The 10-year Treasury yield continues to stick to that 1.6% area in spite of investors worrying about inflation and the Fed printing more money and more stimulus coming out. I think bondholders are sending us a message that we need to take seriously, that as worried, usually it's, let me put it this way. Usually it's the bondholders who worry about inflation. The bond market is the worrier of inflation. But I think the fact that the 10-year Treasury continues to stick around 1.6%, I'll just show you this real quick over here. You see this 1.6%? Okay. I think we have to take this message seriously and say bond investors are usually the ones who are more worried about inflation than the stock investors. The bond investors lead the way in terms of worrying about inflation. Yet the stock investors, all you hear and read in the media, I hope I didn't come off the wrong way. This is not a knock to media or anybody like that. I'm just saying, I'm part of the media, okay? What you're hearing is the professionals all talking about in the stock market, but what about inflation? What about inflation this, inflation that? And it's sending the stock market all over the place, up and down. But bondholders have been steady. They have been cold as ice, 1.6%, so sticky on the 10-year Treasury. So maybe bond investors, who are typically considered the smarter between bond and stock investors, maybe they're saying, we are agreeing with Jerome Powell, the chairman of the Federal Reserve, that any surge in inflation will moderate over the next 6 to 12 months, and it'll go away. And we'll be back to a period of low unemployment and low inflation, just like the olden days. That's what I think the message is, at least from the bond market, subject to change. Let's take a look at the VIX. This is significant. I'm going to blow this up a little more so you could see. You see this VIX here? It's at 18.4. I talk about this pretty much every day. And I said, if the VIX could get below 20, we're going to see another surge in the stock market. If the VIX goes above 25, we're going to see a bad dip, a bad market. So what happens is the VIX has gone below 20, and you see what's happening. The stock market has been surging. We've been talking about this for a couple of days. It's been around 20, and it's making stock investors feel a lot. It's indicating that stock investors are getting comfortable again, committing money into the stock market. And you can't deny it. It's right here. The VIX is 18.4. Okay, just to make sure we take a look at that. Okay, 18.4. You see I highlighted over there in blue? So with the VIX under 20, that's pretty darn bullish in my opinion. And I don't think the market, I think the market is done backing off. We've had this downbeat market. We got through the crypto plunge. We got through the meme stock plunge. We got through the inflation worries where the 10-year yield went to 1.75, 1.77. The stock market keeps jumping over these hurdles. The big five stocks, not including Netflix. So I'm talking about Facebook, Amazon, Apple, Google, and Microsoft, they represented 25% of the S&P 500 just a few months ago. Fun fact, they only represent 21% of the S&P 500 now. So while they've gone down as a percentage of the S&P 500, the reason the market's holding up overall is because so many other stocks are taking up the slack. The rally has broadened. That's a very good thing. Yes, I know what you're saying. Yeah, but what about DoorDash and Teladoc and DocuSign and Peloton and so many other stocks that have plunged? Those stocks are not part of the S&P 500, so they don't really count as much. Yeah, I know if you own them and you're suffering, they count a heck of a lot. But I'm talking about the major averages, which have held up incredibly well. All right, let's take a quick look. Let's take a gander. So do people use that word anymore, gander? Let's take a gander at some of the industrials. Like Boeing was up. GE was off a little bit. Eaton was up a little bit. But let's take a look. Let's go to the list view. Let's go to the FANG stocks, the FANG-M stocks. Look, Google, also known as Alphabet. By the way, Google is Alphabet. Google is just a component now of the overarching company called Alphabet. And Alphabet was up almost 3% today. That's a huge day. Facebook up over 2.5%. A huge day. Look, Facebook was like $302, $303 a week ago. Now it's $324. Microsoft continues to stay in that 250 range, up over 2%. Apple, Amazon, Netflix up over 1%. When these stocks have such a big day, the S&P, which was up 0.99% today, it can't help but go up. Hey guys, you have any questions about this stuff? Ask me in the comments. I love that. We just say hello. We're just, words of encouragement, words of wisdom. I'm game. It's the comments. It makes it fun. Let's get back to the share screen. Okay. Yeah, we're flying through this. 17 minutes into this. So let's just take a look at the major sector ETFs. This is like my main dashboard, by the way. I look at this a couple times a day. It just gives me a quick reference point of where stocks are. Communications, technology, leading the way. Half of the XLC is Facebook and Google. Facebook and Netflix. So communications and technology, which basically are very correlated, were the biggest winning parts of the day. So that's why the Nasdaq was up so much. Real estate held up pretty well. Energy held up. Building materials, industrials, financials, healthcare. Basically, everything was up except for utilities. Utilities are only off a drop. And when utilities drop, it's usually not a particularly volatile trade. If you look at the green line over here, the red is how far each sector is down from its all-time high. And it's not down much from its all-time high. But other areas like healthcare are right at their highs. Consumer staples are still at their highs. Industrials are still near their highs. Everything is still pretty much at its highs as far as large cap stocks go. So that's the story. And I'm sticking with it. And I will see you soon. And I'm going to switch one more time and say thank you for joining me. We're going to have a little bit more personal finance stuff. And I'm on YouTube. Check me out there. It's a Client First Strategy. I'm on Instagram at InstaMitchG, Twitter, Mitch_Goldberg, Facebook, Client First Strategy, and LinkedIn, Mitchell Goldberg, AIF. All right. I will speak with you soon. Thank you so much for watching.